In your everyday existence, you are confronted with the transfers of your wealth. You continuously, unknowingly, and unnecessarily give or transfer money away.
Not only do you give this money away, but you also lose the ability to earn money on that money once it's transferred. This compounds your loss. To eliminate or reduce these transfers, you must first learn to recognize them, then understand how directly or indirectly they cost you money.
You may have to confront conventional financial wisdom. Remember, the ones giving you these financial programs tend to profit from them the most. Always ask, who would profit from these transfers?
Now, what are some examples? Well, the primary transfers are these: taxes, how you pay your mortgage, how you fund your qualified retirement plans, tax refunds, financial planning, life insurance, how you make major purchases like cars, your debt like your credit cards and other non-deductible debt, and of course, other investments.
These transfers can create financial losses for you. On the surface, the transfers seem pretty basic. It is not until you think a layer deeper that you find that these transfers may cause unintended consequences for you in the future.
Lost opportunity cost is very important and plays a huge role in this. If you spend $1, not only do you lose that dollar, but also the ability to earn money from that dollar. To give you an example of lost opportunity cost, let's use the cost of paying cash for a car.
Okay, the first lesson you must learn and remember is the mathematical rule of 72. Remember, it works like this. If you can get a 10% rate of return, your money will double every 7.2 years. If you can get a 7.2% rate of return, your money will double every 10 years.
So let's take a look at that car. Let's also assume you're 25 years old and you paid $20,000 for this fine ride in cash.
Thanks, Grandma.
Yeah. And if we use the rule of 72, that $20,000 would double its value every 7.2 years if it earned a constant 10% rate of return. And let's see how those values grow.
So Kelly, at age 68, that $20,000 would have grown to $1,280,000. If it had earned a 7.2% return and therefore doubled every 10 years, then at age 85, you'd have the same $1,280,000. Not too bad.
Let's take a look at the lost opportunity cost. If the 20 grand would have grown to just over 1.2 million, the lost opportunity cost would be the difference between the $20,000 you spent and the $1,280,000 it could have become if you hadn't spent it.
That's right. The future value of that $20,000 would have created substantial wealth if it had not been spent. Therefore, the lost opportunity cost on the cost of this car is $1,260,000. Now that's one sweet ride.
Yeah. So what? Are we saying never buy a car?
Of course not. But you must understand that any purchase or transfer of your money through taxes, interest rates, fees, etc. creates lost opportunity costs. Would it not be a wise decision to eliminate or reduce as many of those transfers as you could?
In reducing these transfers, you can truly watch your wealth grow. You can keep more of the money that you were unknowingly and unnecessarily giving away. What if there is a way to have bought the car and at the same time not lost the $1,260,000 in lost opportunity costs?
I mean, would you at least be curious? You can do that. We can show you how.
So keep watching. We call this financial caffeine. Make sure to watch the Who We Are video. This will start to make sense. If an empowering education that will help you to explore and evaluate your available strategies so you can discover how you can enjoy greater wealth without taking on greater risks or crimping your lifestyle makes sense to you, then contact Prosperity Intelligence to